Hello everyone, this is Andrew McNair from SWAN Capital with our August 2020 SWAN report. In this month's video, we're going to discuss some recent headlines that influenced the financial markets in July, but also provides you some perspective on what these developments actually mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. Now, stocks rose in July as better than expected corporate earnings and really progress on this COVID-19 vaccine really encouraged investors. As we turn our gaze to the three major indexes, we start with the S&P 500, which is made up of 500 large U.S. companies. Well, it gained 5.5%. The NASDAQ picked up 6.8%, which is made up primarily of technology companies. And the Dow, which is a smaller group of companies, very large companies, actually lagged much of the year, and it only rose 2.4%. Now, stocks raced higher at the start of this month as the NASDAQ set multiple fresh record highs. But overall, economic reports were upbeat, and investors focused on the positive trial results from a COVID-19 treatment. Now, stock prices did start to slip after an uptick in jobless claims and the increasing U.S. tensions between us and China. But the markets closed this month strong after mega-cap technology names checked in with solid numbers in the second quarter. These were companies like Amazon, Google, and Apple that are still doing well. Now, the month of August has gained a reputation in history for being one of the more volatile months of the year. Last August, for instance, the S&P 500 posted 11 moves of more than 1% in 22 trading days. Now, one of the reasons for this volatility historically is that many traders are away on vacation, resulting in lighter volume, and that amplifies potentially market volatility. Now, this August, very few people are going to be taking vacations, and so August will have to stand on its own merits. But investors should be prepared for headlines that result in outsized moves and larger moves than expected. But so far, we've had some good news on the economy this week, with signs that manufacturing is expanding and the job numbers surprisingly have tilted to the upside. After last week's confirmation that we are officially in a recession, the markets were pushed upward on hopes of a new stimulus deal that's helped millions of potential unemployed Americans. Sadly, at the time of this video, Congress can't decide on much, with Republicans and Democrats having their proposals immensely different. President Donald Trump had to promise to extend unemployment and housing assistance benefits by executive order, which may or not be illegal, but still, it wouldn't be good to be on the person or the group that tries to sue to stop the assistance to these unemployed Americans. Now, over the next 3 months, it will probably be very volatile. There's already a vast philosophical difference in our country as we are trying to figure out how to deal with things. And it seems as our country has never been more divided as a nation. And it's not going to be helped with this election year, because from either political spectrum, I can't imagine them not using COVID-19 mayhem to try to impact their campaign. But how will the division impact the markets? In the broadest sense, markets hate uncertainty. Contradictory and divisive policies, such as no mask, school, no school, church, or maybe no church, will only create more of that uncertainty. I predict that in response, people will stop spending, businesses won't hire, and may shut down. And voila, the market will get very volatile and nervous. In other financial news involving China, the impetus to have Chinese companies comply with U.S. accounting standards to level the playing field for exchange-listed companies has been gaining a lot of steam recently. And the recommendation calls for delisting any Chinese companies that don't adopt these standards. And according to an article in the Investor's Business Daily, this move generally seeks to hold Chinese companies to the same disclosure standards as everyone else. We just want China, and every country for that matter, to play fairly. So the Public Company Accounting Oversight Board, the PCAOB, agreed to allow Chinese companies to access the U.S. markets in 2013, but they were supposed to meet our U.S. standards. Well, China hasn't held up its end of the deal, leaving regulators unable to protect investors from fraudulent accounting. Not surprisingly, China's response, it doesn't agree with these actions, nor the Trump administration. So there's a lot to keep eye on as we close in on this election year and as the market becomes more and more potentially overvalued, we're going to keep our eyes on the market and our clients' portfolios going forward. I want to sign off for the month of August 2020, and we'll see you next month.